Um, as you repeatedly emphasize, communication and transparency are very important for the Fed.
The administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood. And my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year, and then, or at least not making any progress, and then we'll resume that progress as we can. When you think about supply disruptions, that is the kind of thing that can take time to resolve, and it can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that that process will take some years and that the inflationary process might be extended. So these are all of this is highly uncertain. We're thinking now really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are, and then we can make a better assessment of what the economic effects will be. Part of why growth was so strong in the last couple of years was just very high levels of immigration, and those people went to work. The economy hired them. There was a lot of demand. We were still working off the labor shortage. What's happened since the prior administration changed their policy, as you mentioned, immigration has fallen very sharply, and therefore the growth of workers has really stopped. It's really stagnant. But at the same time, demand has also fallen. And so demand for workers, so payroll job creation has also fallen, and they've kind of fallen in tandem, which is why the unemployment rate has been pretty stable for about a year. So in a way, demand and coincidentally perhaps to some extent, demand and supply for workers has fallen. In terms of the effect on the labor market, right now we're still at full employment. And labor force participation is still strong. Wages have moved back down to levels that are now pretty sustainable, given an assumption about productivity. So the labor market's in a really good place. So it's too soon to say, but what I can say is, of course, the people being laid off in government, this is highly significant to them. We don't know how big that's going to be. Right now, it's not big enough to affect a workforce of 170 million people materially. In terms of the cutbacks in funding and for science and things like that, we do see in areas, particularly in cities that have a lot of universities and research hospitals and research institutions, we're really hearing significant layoffs and significant impacts on employment. I don't know how much that will total up to, and of course, in addition, cutting back on scientific research may have implications for economic growth, for productivity, for health, for all kinds of things, but those are very difficult to estimate in real time.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on, and it's really the policies, particularly the trade policy, and really the question is, where's that going to come in, where's that going to land, and we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function. Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in effect, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers, and we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So, you know, Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties and in both sides of the Hill. So I think that's not a problem. There's a Supreme Court case people will have read probably in today's Journal at which the Supreme Court may decide whether independent agencies generally, whether their authorizing laws can contain a provision that prevents the president from firing members of a commission other than for cause. And that's a case that people are talking about a lot. I don't think that decision will apply to the Fed, but I don't know. It's a situation that we're monitoring carefully.